There are numerous financial opportunities available in the world, and it seems like some people get rich without much effort by investing in assets like Bitcoin, GameStop stocks, and more. However, these cases are outliers, and most of us cannot expect to make millions of dollars in a short amount of time. Nevertheless, it is still possible to accumulate wealth over a longer period by investing in public markets. Public markets are the best wealth builders on the planet in the long run, and investing is something that cannot be overlooked. While wages have increased over the last century, inflation has also increased, leaving the purchasing power relatively unchanged. Hence, it is more likely to lose money in the long term if one does not invest. However, investing can be difficult as it goes against human nature, which requires immediate gratification. Investing is about managing emotions, and many people swear off investing after experiencing a significant loss during a market downturn. In this video, the speaker shares their personal experience of investing in the stock market in 2007 and losing 60% of the invested amount within a year, leading them to stop investing altogether. However, they learned that successful investing involves managing emotions and applied Stoicism to their investing strategy, which made the process easier. The video provides insights into how viewers can use Stoicism to become better investors and manage their emotions during investing decisions. For those already good at investing, they can use the philosophy to become less emotional while making investment decisions. How did the Stoics view money? Stoicism is essentially a survival plan that safeguards your mental health, but it can also be extended to secure your financial resources. The fundamental principle of Stoicism is understanding and distinguishing what you can control from what you cannot. The simplicity of this philosophy is that it can be summed up in a single sentence. However, in contrast to popular belief, the Stoics didn't reject money and riches. They recognized that money is something outside of our control. Here's a quote from Epictetus, who was one of the most rigorous Stoics, about money. "If you can make money remaining honest, trustworthy, and dignified, by all means do it. But you don't have to make money if you have to compromise your integrity." I appreciate this way of thinking because it doesn't assign a value judgment to money. If you want to pursue wealth, go ahead. And if you don't achieve wealth, it's not a big deal. This is the fundamental perspective of a Stoic approach to money. While there are more important things in life than riches, such as living with integrity and following your values, that doesn't diminish the importance of wealth entirely. The question is, can you become wealthy and live like a Stoic? The Stoic Path to Wealth Explained. Seneca, Epictetus, William James, and Ralph Waldo Emerson have greatly influenced me. Although I have applied Stoic philosophy to both my personal life and investment strategy, I consider myself a pragmatist. I have studied the investment strategies of several value investors, including Warren Buffett, Charlie Munger, Peter Lynch, Bill Ackman, Joel Greenblatt, and the indexing legend John Bogle. However, to broaden my knowledge of investing, I have also studied the strategies of traders and growth investors such as Jesse Livermore, George Soros, and Paul Tudor Jones. After years of studying these various philosophies and investment strategies, I have found that there are 3 important milestones for building wealth. I refer to this as the Stoic path to wealth because I have noticed Stoic qualities in every successful investor. This is a brief overview of the roadmap. Earn money. To begin investing, it's not necessary to be wealthy, but it is necessary to make more money than what you spend on basic necessities. To increase income in our current economy, it's important to have skills that generate income such as writing, coding, public speaking, leadership, and others. Learning skills is a Stoic approach because it involves focusing on what you can control. In today's economy, those who can create value with their skills will likely never face prolonged unemployment. Every investor that I've studied started earning a living by putting in the work. Most of them had jobs, working for someone else. Warren Buffett worked as a securities analyst at Graham Newman from 1954 to 1956. He started his own partnership after that. George Soros pursued multiple academic degrees between 1947 and 1954. Then, he took a job as a clerk at a small investment bank. I can go on for a while, but you get the point. We all need to get started with earning money as the foundation of wealth building. It means you can create value from nothing but your skills. Lose money. Most resources on wealth fail to address the crucial topic of handling losses. Many individuals have a strong aversion to losing money, which I can personally relate to. During my childhood, my family faced financial difficulties and were buried in debt, which made me extremely cautious with my own money as I started earning. However, this mindset can be problematic if you want to pursue investing seriously. I can't think of a single successful investor who did not lose money. In fact, the strategies of the majority of investors I mentioned are shaped by their losses. I can't cover all of this in this video, but look into the history of Warren Buffett. Berkshire Hathaway was a failed textile company. Bill Ackman, who lost big on his short against Herbalife. George Soros lost 22% in 1981 on British government bonds. Their biggest successes often came after their losses. This is a critical concept in building wealth. You must be okay with losing. Otherwise, you will never take a risk with your money. And what is investing? Taking risks. The best investors look at wealth building as a game. It's just like sports. Even the most successful teams in the history of the NBA, NFL, MLB will lose multiple games on their paths to a championship. The key is to never lose big. When you invest, do everything you can to never lose more than 10% of your investment. You can always come back from that. Just because there are different investment philosophies, it doesn't mean you need to religiously follow a particular style. Use your common sense, protect the downside, and most importantly, build up your investments slowly. Grow money. Stoic investors aim to make wise investments that have significant potential returns. In the event that those investments fail, they do not suffer complete financial loss. To increase your wealth, invest your money in assets that appreciate in value or generate cash flow, preferably both. The challenge lies in selecting the right assets. Personally, I began by investing in high-quality property due to its relatively low risk, but it also has a low return on investment. I am currently earning a net return of 6% after factoring in costs. This is a common rate of return in the real estate market. If you go to YouTube or Reddit, there are thousands of salesmen who want to make you believe that stocks are the best way to wealth. I don't agree with that. It's just one way to invest. When it comes to the stock market, most investors agree that index funds are the way to go for most people. If you have more money, you could hire a financial planner or wealth management firm. But that pays off when you've acquired substantial wealth, not when you're starting. But what if you want to start investing by yourself without risking getting wiped out? I have a rule for that. The 9-to-1 rule of investing. Most of us don't have the desire to become full-time investors who want to beat the market. In the long term, you're better off putting your money in something like an S&P 500 or a total stock market index fund. It's the best way to get market returns without any effort. But what about those individuals who want a little bit more upside? The people who are interested in the markets and want to take some risk, but don't want to lose a lot of money. I'm like that as well. While I've been investing since 2007, my career is in writing and teaching. I enjoy my work and I don't want to be a full-time trader, but I still like to take a little bit of risk and potentially have a higher upside. We call that speculation. All the short-term success you see about Bitcoin, trending stocks, currencies or commodities are all about speculation. You buy an asset and hope to sell it at a higher price. Nothing wrong with that. I know that a lot of index fund enthusiasts are not a fan of speculation, but I don't mind it. I just don't want to put all my money on the line. So I created the 9-to-1 rule of investing, which states that you put 90% of the money you allocate to stock investing in an index fund, and you use 10% to speculate. I take 90% of the money I want to invest in the market and put it in an index fund like Vanguard S and P500 ETF. And I use 10% to make a few bets on things I think will take off. But since I'm taking risks with a small percentage of my money that's meant for the stock market, I'm not taking a big hit if my riskier bets don't pay off. And if they do, I'll take the extra return. Start investing. Don't look for more answers. At some point, you must take action. But we tend to keep searching for that special piece of wisdom that makes the difference. So we keep reading more books, listening to more podcasts, and following the different investing sages. As a result, we never take action, and we become our own worst enemy. No one said it better than Epictetus. Your relentless pursuit of wisdom postpones your actually possessing it. Quit chasing after tonics and new teachers. The latest fashionable sage or book or diet or belief doesn't move you in the direction of a flourishing life. You do. Until you take your own money and put it on the line, you never know what it feels like to invest. I can say that I've made nearly all the investing mistakes one can make. I betted on popular assets that got cut in half within 24 hours. I've bought high and sold low dozens of times. I've bought low, sold a bit higher, and missed the biggest rise in price because I got out early. I've pulled out my money from an index fund, only to get back in when it recovered. But Stoicism has helped me to become a better investor because it made me more level-headed. Every time you invest in something, you're taking a risk with your hard-earned money, which will always remain scary. But no matter what happens, don't talk yourself out of investing. You can't afford it. In the long term, markets still move in one direction, up. You either take the ride up, or you stay where you are. I hope you found this video useful, and it would tickle me pink if you all could leave a comment down yonder. If it suits your fancy, you could also give our channel a follow, but no pressure, partner.